Welcome to your Money Morsel with Harvard House, where we use the power of social media and video to get you closer to the markets and what's happening day to day. Good morning. I'm sitting with Michael Porter, Chief Investment Officer of Harvard House. Michael, good morning to you.
Morning, Robin.
January has been a particularly busy start. There seems to be a lot happening. I see that markets have come off quite aggressively, certainly in the US. I see that Spotify is down nearly 50%, Netflix, Amazon, all down big numbers. Can you tell us what's happening and give us some sort of insights on what's making these things happen?
Sure, Robin. It certainly has been a busy start to the year. It's hard to believe that we're at the end of January already. If you read intuition at the start of the year, I think what probably came out was that December was a particularly strong month. So to some extent, I think some of the moves in January are a bit of a correction from the over-exuberance of December, where markets got pushed hard in the last couple of weeks of the year. But really, Robin, it's actually all about US interest rates. So what has manifested itself this year is inflation coming through. It's been around for much of last year, but it really has bubbled to the surface. Everybody's now focusing attention on it. And in addition to that, the Federal Reserve at their meeting earlier this week basically came out and said they were concerned about inflation for the first time, because up till now they've basically said, no, it's under control, we're not panicking. So the change of tone caught the market by surprise, and they basically guided to the fact that they would be hiking interest rates as aggressively as required in order to calm inflation. Now, we've said for quite a long time that shares that are particularly vulnerable to higher interest rates are those with high valuations, where the interest rate rises, it has a disproportionate impact on the valuation of the company, and that's exactly what's happened. So the tech stocks have sold off aggressively on the back of high interest rates. And just to give you an example, the US long bond, which is the 10-year interest rate in the US, has gone from 1.5% at the beginning of the year to 1.85% now, 1.9%. Now, that doesn't sound like a huge amount, 40 basis points, but in percentage terms, that's absolutely enormous, especially for a long bond. So tech stocks have sold off aggressively. Old economy stocks are doing fine, but actually the whole market's come off a little bit, partly because of what happened in December. Yesterday, US GDP growth came out. It was 7% for the fourth quarter last year, which was a very good number, despite Omicron, despite all the other bits and pieces that are going on. And so yeah, I mean, there's not really a growth issue in the US. It's really more just about changing expectations and changing interest rates and some of these valuations coming down to earth, which we've actually said for a long time.
So, Michael, we've seen the price of oil bouncing on $90 a barrel. The Russians are saber rattling on the Ukraine border. What's really driving this inflation? Is it this oil price, or is it wages? Give us some sort of idea of what's driving this inflation.
Yeah, so on the inflationary side, really it's basically those exact two things. So the oil price is at close to $90 a barrel. I think everybody's probably aware of what's happening on the Ukraine border, and no one knows whether we're going to wake up tomorrow and find that they've invaded the Ukraine or not. But there's certainly a lot of tension because Russia is a huge oil exporter. But a conflict in that area would actually destabilize some of the other pipelines, and it would certainly lead to rising oil prices and probably a bit of a shortage initially. So there's certainly some of that. But the other real issue around the world is wage inflation. So companies are basically having to pay up to get people back to work, and they are having to give them not just to pay up, but also give them extra benefits. So wages are rising, but companies are having to shell out extra benefits to get people back to work after the whole COVID pandemic. So US wages are rising at 5%, but inflation 7%. And so your wages are still not rising as fast as inflation, and you can't see wage inflation going down anytime soon. So it does look like inflation is going to be around for longer than what was initially anticipated.
So, Michael, in summary, you're not concerned that the markets are all in and all fall down. GDP growth still seems pretty strong. to back up numbers. This is just a normal correction for a few other environmental factors.
Yeah, I think generally for the outlook for the year is pretty strong. GDP growth we still expect to be robust across the world. So from that point of view, I think the environment is pretty conducive. China is also slowing down, so that's also having some impact. But once the Beijing Olympics, the Winter Olympics are out of the way in a couple of weeks' time, I think we're going to see China start to accelerate again a little bit, because they've been massaging their policies to put their best foot forward. So yes, I think the outlook for the year remains pretty robust. COVID is fading. Some of the companies that are reporting out of the US at the moment are actually reporting very strong earnings growth. And Visa came out last night and just commented on how cross-border travel is really accelerating again, and they don't see evidence that things are slowing down. So yes, we think it's a pretty robust growth outlook, but you do just have to adjust to the new interest rate environment. And what's happening, I think, is quite healthy for the market.
Awesome. Michael, thank you so much for giving us your time. Thank you for tuning in. Please don't forget to subscribe and click the bell to get an alert that we have released a new video, and we'll continue to bring these updates on the market to you. Thank you for your time.